Okay, good morning. Thank you all for joining us for today's coffee talk. My name is Sean O'Brien. I'm the president of Quick Rate. There we go. And as always, I'm pleased to be joined by Steve Huntington. Steve, you want to go ahead and introduce yourself?
Yeah, thanks, Sean. Good morning, everyone. Thanks for joining us today. It's been a little while since we've seen you on a bright, sunny Friday morning, at least here, but we're happy you joined us. My name's Steve Huntington. I'm the director of analytics here at Quick Rate, and spent my entire career working with community financial institutions on a little bit of everything, and more than half that career now working with Sean here at Quick Rate.
Awesome. Thank you, Steve. And we are glad to welcome back our dear friend Paul Allen from Saltmarsh. Paul's here to add to our presentation today. Obviously, some of our best coffee talks are when Paul's here. So, Paul, if you'd like to introduce yourself.
Good morning, Sean and Steve. Thank you for having me back. I'm a director with Saltmarsh, Cleveland and Gunn, and we get a great opportunity to work with credit unions and financial institutions across the country. Especially enjoy hearing about credit risk and CECL and implementation. So I'm looking forward to the conversation today.
Awesome. Thank you for joining us today, Paul. Just a couple of reminders before we get started. We are what's in presentation mode, so hopefully you can see and hear us. And if you have questions, we certainly want to encourage them. I know there's already one queued up in the Q&A box or the chat feature. Just a couple of reminders. We will send out a link to today's recording, along with the copy of the slides and the results of our polling questions. So, without further ado, we do have a few polling questions to get started today. Let me see if I can get those going. Appreciate your participation in these. First one, most of them are familiar questions. The first one is just, are you seeing any increase in your past due loans? Yes, no, or about the same. And share this one. 44% of you are, 35% about the same, and 21% are not. So thank you for answering. Now on to the second question around Q factors. Have your Q factors increased, decreased, or stayed the same so far this year? So again, just increased, decreased, or stayed the same. We'll give it 25 or 30 seconds. Okay. 60% of you have seen them stay the same, 29% of an increase, and 12 decreased. So thank you again. On to the third question, just around your allowance. Has your allowance for credit losses increased, decreased, or stayed the same so far this year? Uh, 52% of you have increased your reserve, 41% have kept it the same, and 7% have decreased the reserve. So the next two questions, there's kind of two-part questions. The first one's really related to regulatory exams. The second one is an auditor exam. So questions here, have you undergone an exam for CECL? And then secondly, if so, how have your auditors responded to your CECL implementation? So just a two-parter here. And again, this first one more for your regulators. The second one here will be for your auditors. So again, thank you for participating. 64% yes, 29% no. And then in terms of responses about your implementation, positively 69%, 25% mixed, 6% critically. So, oops, I didn't think I shared those. So thank you very much for participating on those. And now this follow-up question is really around your audit firm. Have you undergone an audit of your CECL reserves or or excuse me, your reserves under CECL. And then again, secondly, any responses. And that one, 80% yes, 15% no, 5% in progress, and then again, 88% positively, 9% mixed, and 3% critically. So again, thank you all very much for participating in these questions. So since we have Paul, we want to make sure we get his thoughts on a number of issues as it relates to CECL. So at this point, I'll turn it over to Paul. Take it away.
Well, thanks, Sean. It was interesting, the survey questions. Couple things there. We about stayed the same on our qualitative, but our total reserve went up. That was interesting. Part of that probably will be from just growth in the loan portfolio, so we keep that relationship. But we're certainly in an unusual time in the economy right now. So wanted to talk a little bit about the fact that we have gone through the implementation part, right? So all of you have done a great job. I've been so impressed with folks in the financial services industry in terms of undertaking a very significant change, in a major accounting pronouncement change. And so we've gone through that, we've implemented it. And as you might suspect now, we're moving from the drama and the excitement of first implementation to now a more mature process. And Sean, we've gone through this before with other significant accounting policies that changed. Once we go through them, there's a lot of focus on the implementation part, but as you move through that and it becomes a more normal thing, we have to remind ourselves it's not set it and forget it. We have to make sure that we're keeping up with this and moving. So the key areas probably are those three on the bullet point there. All models that we use in the institution periodically have to be validated, and there's a lot of regulatory guidelines on model validation and so forth. So anytime you implement a new model, anytime you make a significant change in your model or model approach, and then periodically just to make sure that it's working correctly. So, I would expect people to be talking a lot more about model validation. You probably have had one model validation. Usually when we put a new model in place, after about 6 months, usually 3 to 6 months, we have a model validation to make sure that the implementation went correctly. And then periodically, we just need to make sure that the people that are running the model and the way the model is running continues to go. The second point is a real time. My goodness, everyone worked so hard in mapping our loan portfolio data and other data into the model, and we got it in there. But life goes on, and we add new product features. We may have slight changes in our core processing software applications. So one of the things that we're really encouraging our clients to do is set up a process and a procedure for checking the mapping of the data and the assumptions into the model correctly. And I will point out that we are seeing a couple of oops, Sean, I hate to say this, but we got it all in correctly the first time, but then we realized that we added a new product, or we changed the loan origination software, we changed the use of certain data fields. And so you want to make sure that you have a process for looking at that. And then that last bullet point is, as we have talked about consistently, most of our reserve right now is from qualitative factors, heavily influenced by the economic facts and circumstances going on right now. And Sean, I understand something's going on in the economy right now. There's something in the media, a little
Something
drama,
small,
perhaps.
insignificant.
Yeah, but in all seriousness, before, this past week with the big announcement on tariffs, we already were seeing some changes in credit risk. It's not that we're seeing a huge, meltdown or lots and lots of charge-offs, but we were starting to see increases in past dues, starting to see some increases in the loan metrics that indicate that credit risk is changing. And so we have to be ready to move and shift on that. And so this is a situation where, we point out to you that we don't know where all of this is going, but we do know that we have uncertainty. And so how can we make sure that we're kind of staying ahead of that? On that next slide, Sean, just talked about the fact that we're seeing a little bit of uptick in credit risk. As we go through credit cycles, if we have increases in charge-offs, that's going to shift the balance between how much of our provision or ACL is from charge-offs and how much is qualitative. So in theory, when we went into CECL and we had very little charge-offs and most of our reserve was because of qualitative, as you have more charge-offs, you'd think, okay, well, I thought about that. Now it's happening. So my qualitative would likely go down and my charge-off factors would go up. But that is something that, you have to work through. And so we'd really encourage people to be spending some time and having healthy dialogue with the management, the supervisory committee, and the board about, okay, this is how we're going to kind of stay ahead and look at this. And this is how these credit metrics that may be turning, how are they impacting our portfolio and our risk profile in our institution? And so, we're real interested in, watching this and being ready for change. And I guess that's the message, Sean. I don't know if you'd agree with that, but right now, I think you don't know what the change is going to be, but you need to be ready for a change.
I think absolutely. And again, I think it's one in a, I think in my opinion, like one of the good things about the change to CECL was really the ability to be able to kind of incorporate that into your reserve analysis, right? We were definitely designed to look forward. This is almost a textbook example of where, again, a lot of uncertainty, not sure what's going to happen, but as it becomes clear, or even now with some concern around it, it does give you some flexibility to to account for it if you feel that that's going to impact your portfolio. And I think it was a step in the right direction.
Absolutely. And I think it's fair to say none of us really know exactly where this issue of the tariffs is going to settle down. There may be more negotiation going on. We don't know where that's going to go. But, in all likelihood, just like COVID, this would be a factor that would affect our supply chain. And so, there's probably going to be some disruption in certain industries and certain companies, certain products. And so we just want to be ready for thinking about how to anticipate that, but also anticipating that the credit cycle is turning. We knew we've been waiting for this for a while now, haven't we, Sean?
We have.
The last 2 or 3 years, we've heard from the regulatory agencies that, be careful, the credit cycle is about to turn. Well, it's just starting to turn a little bit. So just want to talk about that. And then on the next slide, there was one other trend that we saw this past audit cycle. For those of you that are on 1231 audit cycles, looking at the financial disclosure this year compared to the first year under CECL has certainly been a little bit of a shift. The first year, understandably, everybody was overwhelmed, worried about the implementation, and we tended to put a lot of disclosure that was a bit boilerplate, a little general. And I think that as we move forward and this becomes more and more normative as a regular accounting policy and procedure, there's going to be an expectation that our financial statement disclosure gets perhaps what I'd call tighter, not necessarily longer, but more specific to what the institution is actually doing and your actual practices and methods rather than, just copying and pasting from some large institution and sticking it in yours. There's going to be an expectation. It should be more tailored, if you will. And we did already notice that this year. If you compare the disclosures year over year, there's been a refinement in that. And so I would be ready to, I'd be ready to continue to look at that, maybe get that better and better as you go forward. Does that make sense, Sean?
Absolutely. And I think it's really a good point, right? That it doesn't necessarily mean that it needs to be more, expanded or, longer. It's just really more specific, right? I think
Right.
over the course of the last couple of years, everybody's got more comfortable in their process in what they do, what they see of high importance. And really now it's just articulating that into your disclosure, right? That it's,
Absolutely.
you know what you're doing. This is what we're doing. This is what we rely on. This is what we value. Just make sure your disclosure kind of reflects that.
Absolutely. And so we tried to think about, so if those are the trends, a lot of focus on model validation, a lot of focus on mapping, a lot of focus on being ready for shifts. How would that impact? And so I took the liberty of putting a few bullet points there, Sean, on that next slide. Just if we could put our arm around everyone's shoulder and say, okay, what do we think we should be doing in 2025 for the rest of the year? First of all, I think there should be some healthy and robust conversations with senior management and your board about the fact that we don't know exactly what the impact is, but there's obviously strong indicators that economic factors are changing, and probably there will be an expectation that that translates into something in terms of the weighting of the qualitative themselves, and then as we see charge-offs. And so should have some discussion about that. I think your regulators and auditors are going to be expecting you to tell them, and I would encourage you always to tell your story, not wait for the auditors to tell you what your story is. So, I would expect to be ready for that. And certainly you can use peer analysis and watching the media. Those are important things. Steve, I think you're going to go on a little bit later in the webinar today, some of the tools that are in the model in terms of looking at peer analysis and so forth. And then just finally, I would encourage you to have those discussions, including with the loan and underwriting staff. Given all that's going on, I certainly would not think this is the time to lower our underwriting standards. I think everybody should be on the same page that we may not be stopping doing anything or slowing down necessarily, but we certainly want to be making sure that we're getting, putting the best credits on the books and doing a really good job of monitoring our borrowers, particularly those borrowers that may be impacted by supply chain disruptions. Again, we already hear in the news it's going to affect cars. Obviously, it's going to affect appliances and things that have chips and semiconductors and things like that in them. So, looking at that. And Sean, I don't know if it happens in your market, but we're seeing, some stress in the ag market, even before not having to do anything tariffs, but, agricultural borrowers were already having a little bit of stress. So, there's a lot of things to think about. So it's too early to know exactly what that impact is, but it isn't too early to start preparing and kind of clearing the decks and being ready for a change.
That's right. Again, we talk a lot about being directionally accurate. And again, I think, as Paul said, right, it's not clear exactly what the impact's going to be, but directionally, right, it's certainly more uncertain, certainly more adverse than it's been over the past few years. So, we know which direction it's going. How far it goes in that direction remains to be seen. But again, I think as we're thinking about our Q factors, we definitely know there's a direction that we're going, which is not as good as it's been over the past few years.
Yep, yep. And I live here in Florida, and so every time we go into hurricane season, we have a big blast of everyone in the world telling us, hey, before the storm hits, be prepared. Get some water, get some dry matches, get all those things. So this is sort of the theme that we're talking about. We're not in the storm necessarily yet, but this would be a good time to really sort of clear the decks and be ready for that. And a couple other things you could be doing. When we recently had storm damage come through and hit a couple different market areas, one of the things that institutions did was they looked at just the portion of the loan portfolio that may be borrowers impacted by storm damage, and sort of taken a separate look at those. In the same way, we could look at specific industries or specific loan types, and relook at those and kind of take a check of, is there a credit stress uniquely to that area, or to that product line? And so that's something that I would encourage you to do. And then secondly, if you're in leadership of your institution, I would stop and check and say, what are our written policies and procedures to make sure that model validation occurs, it's not forgotten about, mapping is done periodically. Steve, you got some great tools in the model that you can take the loan portfolio and strip the assumptions and look for maturity date or rates, the high, sorting things by highest and lowing, and look for outliers. So doing that on a periodic basis to make sure that your mapping is correct, and who has access to those tools to make sure that nobody's inadvertently changing those. So all of that process and procedures, I would encourage you to have it documented, because your auditors and examiners are gonna, if you just say, we do that, yeah. When do you do it? Who does it? How frequently? Let me see the procedures. So this would be a great time to spend a little bit of time just making sure that the process is working well.
Yeah, and one example of that Sean and I see out in the field, so to speak, on a relatively regular basis, has to do with, again, now that we're done with the excitement of the implementation and we're in the doldrums of the maintenance, things like as Paul was suggesting, looking at that loan level data, right? Our CECLSolver tool is designed to make assumptions for the most part around at the pool level, at the segment level. However, there's one piece of data that we have to get at the loan level in order to calculate the reserve, and that's the weighted average remaining maturities, right? So we look at either you use your loan level data to calculate your WARMs, or you're sending it to us and we're using it. But something that we see quite frequently is either an institution had a new product or a new sub product type that they added to their portfolio, and it was managed differently from the core as far as where fields originate within the core, maybe how things like maturity dates are mapped, particularly segments that are things like lines of credit that don't have your typical stated maturity date. Whether you've changed your core processor or added in a type of participation loan, and those that are getting participated over either at the core itself or when asking for a core extract to send us your loan level data so we can help you calculate the WARMs. We see it a lot in the translation between different systems, that a line of credit may used to have just a blank spot cell, right, when it comes to maturity date. Sometimes it'll say NA instead of blank. Sometimes it'll just pick a random date like 12/31/99 for all loans that don't have a stated contractual maturity date. And how those values translate over from system to system and how you send them to us if we're calculating your WARMs can certainly have an impact. So it's just a good practice to periodically be going over that data. And the best way to do that, the way I've found that catches the vast majority of those types of errors, is in automating it, right? Getting a list of all those loans and just sorting low to high. sorting recent to
Exactly.
to less recent when it comes to maturity date, and looking at the top 5 and the bottom 5. And you might find that there was 50 participation loans that of a particular type that don't have a stated contractual maturity date, that you used to get them and they had, 12/31/39 as a date, and now they all say 12/31/99. Now suddenly your warms are twice as long as they're supposed to be. And so those are just kind of flags, things to look out for, that that certainly can change over time. And it's, if you set it and forget it, sooner or later the core is going to change how they handle something or how they extract something, and then you can get into trouble.
That's a great point. I remember working with a client, and they did a similar thing. They took their loan portfolio and sorted it on interest rate, high to low. And, immediately I saw panic on the faces, because we had loans that were, 0.5 or 1%, which there was obviously an error in that, or, 25% or something, there was an error in that. So, those are examples of checking your mapping. So you can also check mapping to make sure that each pool, just select a pool and look at the loans in that pool to make sure that if that pool is supposed to be residential, is it all residential? Or is it, is it all HELOC or whatever, auto loan or whatever? Because occasionally, things will get shifted. And as Steve mentioned, it doesn't take a whole core conversion for your core to change a feature in an update that moves a field, that suddenly moves a loan into a different group. So we're not asking you to check 100%. We're asking you that you have a normal process to take a sample, and that somebody does that on a periodic basis. Probably best practice is doing it once a quarter, but certainly an annual mapping process is very important, because, as we always say, garbage in, garbage out, right? So if we've mapped it wrong, the result's going to be wrong, but it may be, slightly wrong and not, catch up with you right away. So you want to just have a process in place.
Yeah. And for those of you who are using us to calculate your warms for you, Melanie Capasso and our crew do a great job of catching those a lot of times, but nobody knows your data like you do. And so while we'll certainly, we know when we get that data from you and we calculate those warms, we send you that entire Excel file back. So you have an Excel file that's organized by loan type, that you can very quickly sort the loans in each tab by maturity date, and without changing any of the calculations in the file. And that's right there would be a very quick way to eyeball any potential issues. Most of the data points for a particular loan in the file are irrelevant to the warm calculation, right? You really just need what pool is it in, what's the balance, and what's the maturity date. So you don't have to worry about validating 75 other data points for purposes of warm calculations. So try to focus your energy on the things that actually matter, right, in the calculations and the validations from a CECL reserve standpoint, at least.
Steve, while you're on the warm, there was a question about how often that's recalculated. You might want to just talk about how that happens, and on each pool, each time they run the model.
Yeah. So for the vast majority of our users, and for banks and credit unions, both around the country, warms are typically being recalculated on a quarterly basis. Now, we do have some institutions, typically larger institutions, that are calculating or using our tool not just on on a quarterly. They're doing a more thorough reevaluation quarterly, but they're using our tool, calculating scenarios on a monthly basis. And even for our users that are calculating everything on a monthly basis, they're still typically only recalculating the warms on a quarterly basis. Because if you think about it, there's really not, unless you have a huge change, if you make an acquisition of another institution or you get into another loan type significantly, there's not going to be very much that's going to cause a significant change in your warms on a month-to-month basis. Now, if you think about the only other thing that has a significant impact on warms is things like prepayment rates, right? So the interest rate environment is going to have an impact on your warms just by itself because it's an assumption going into it. But more frequently than quarterly, we almost never see that the juice is worth the squeeze, so to speak. So we typically suggest quarterly. Could you get by with doing it twice a year? I don't know, but I would say the vast majority are doing the whole process once a quarter.
Yeah, I think I would say, Justin, thank you for the comment. He calculates his monthly. I think to Steve's point, you could do it semi-annually, but I think we have heard in the course of exams that the auditors for sure would prefer it to be a bit more timely, regulators as well. So again, even though materially they don't typically change a whole lot, I know we had a couple instances where regulators did want it to be more current or more closely associated with the current portfolio. And so for whatever that is worth.
Now, I would say if you're using our tool to calculate your warrants, we do it, we offer it quarterly. So as part of our process, we'll do it for you quarterly, even if you only want it semi-annually. But if you are calculating your own worms, and let's say it's a huge hassle for you, but you want to continue doing it, and you're doing it semi-annually, you should have at least a process where you can at least quarterly reconsider like the prepayment assumption, right? Because that's one assumption you can overlay over the same loan data. So you can take the same data and only semi-annually do a pull from your core of all that loan data, but just on a quarterly basis, maybe you can just change have a knob you can turn for a prepayment, so you can at least say that you've considered anything in the market that may have changed on a quarterly basis. So then maybe that's a hybrid approach for someone in that situation.
Yep. Another question came in. Will these slides be shared? Yes, we will share these along with a link to the recording and the responses to the polling questions. So likely to be in your inbox on Monday. But yes, we will send all of the slides. Okay, so as we've done, kind of consistently in these presentations, and we do try to, the best we can, keep you up to date on anything that's being added to enhance, hopefully the use of CECLSolver. Typically, normally none of these things ever impact the calculations, if ever, but we really, again, try to continually improve your experience as a user. So a couple of things that we've touched on in the past, Steve will give further updates to today, or just reminders of some additional enhancements forthcoming. Steve, anything you want to touch on immediately, or just go right to the next slide?
Let's go right to the next slide.
Okay, and just as a reminder, these are always optional, never required, always optional. All right.
All right, so well, it still says coming soon. It's here. I didn't update that slide from this is what we shared a couple months ago when we let everyone know that we were going to be improving the scenario management, and a lot of that is the result of many of our users. You guys have been with us for a long time now, and you have a ton of scenarios and wanted a better way to be able to sort through them and manage them. So that's now live on the system. Let me go ahead and share my screen so I can kind of walk you through it again in a more interactive way. Give me just a second.
And while you're doing that, Tammy, thanks for the comment. She's a $187 million credit union, and she just was through an NCUA exam, and quarterly updating the warms was okay. So thank you for sharing that.
Here we go. So here is the sort of the main page when you first log into the CECLSolver tool. I will point out that we do have a video clip up here, a helpful hint that kind of walks you through how the new scenario management tool works. What you're used to seeing in here in the past is a drop-down list right here, which just has a list of all your scenarios, just kind of in a chronological type order, but not really organized in any way, shape, or form, and then a save scenario or save scenario as new button. Now the management of the scenarios is all through this one button. So let's say we just open up a tool, we want to open up a scenario, we'll just click on here. You can see now all of your scenarios are organized chronologically by year, so we can just focus on more recent ones. If you want to expand 2023 and pull up an old one, you certainly can. But if I expand 2025, these are ones that we've done more recently. And if I want to go ahead and open one up, I'll just click on select. When I do that, you'll see it's opening the scenario right in the background. And there it is. So now that scenario, you'll see right here, CU saving test. That's the name of the scenario that I just opened. So if this is last quarters and you just opened it now, you can start working on it like you normally would. And when you're done and you want to save it as the next quarters, or even just kind of save your work as you go, you'll just click on the pop-up button there. You can see the highlighted one is the one that you have open, your current scenario. And if you've made some changes to it and you want to resave it, save over it, you can click resave and it'll remind you, hey, by the way, you're resaving on top of this scenario, right? So you're overwriting on top of what you have before. Do you want to do that? And you can say yes or no. But if you want to save it as a new scenario, right? If this was last quarters and you just opened it and spent some time updating everything, and now you want to save it as this quarters, you'll go ahead and click on save as new, give it a new name. So new April 25, and click save. So now you can see the name of the scenario changed to the one I just gave it, and now you have saved your newer updated scenario. Now we put some guardrails in there to try to help you out if you're in the middle of, if you've made a bunch of changes and you decide you want to go somewhere else or go to another website or something like that. There is a pop-up button that reminds you that, hey, by the way, you haven't saved your scenario yet. You should probably do that before you go somewhere else. But I know everyone's got different types of web browsers, and pop-up blockers are a big thing these days. And so there could be something that's stopping you from getting that pop-up, that kind of extra level of safety and warning against saving, not having unsaved data. And so just to be clear, when you're done working within the CECLSolver, you want to make sure that you save the scenario either by opening up the management box here and either resaving the highlighted current scenario or saving it as a new one. And if you have one open and you decide to open a separate one, a different one, you can do that. But then let's say I pulled up this other scenario. I'm going to go ahead and let it load up here for a second. And if I change something in it, and then I decide to select a different scenario, it'll remind you, hey, by the way, you changed something in that old scenario. Do you want to proceed to open up this other one without saving it? Yes or no. So it'll remind you to do that as well. But we know that a lot of people, if you're like me, you like to save your work as you go, so you don't end up working on something for an hour and a half and then your internet connection goes or your laptop dies or something else happens and you lose the work that you've done. And the easiest way to do that is just to have a separate little save button, so you don't have to open up the pop-up and find the scenario and click resave. So we're adding just a very simple save button, a green one right here. That'll be live during the week next week, so that as you're working on a scenario, as you're updating it, at any given point in time, you can just go ahead and click save, so you can save your work as you go. So we're trying to make it as intuitive and user-friendly as possible with the least chance of losing any time or effort that you spent. Anyone who has any things they like about it or don't like about it, feel free to hit us up on our inbox or shoot us a message, and we'll continue trying to tweak it to make it as practical and intuitive as we can. John?
Great. Thanks, Steve. I know Paul's working on typing an answer, but we got a couple of questions around model validation. Why do we have to all have the same tool, third-party model validated? If CECLSolver is validated by one firm, why isn't it good for all? And so, again, and Paul will do a better job explaining this, but there's really two kind of parallel paths for model validation. There's one path that we as the solution provider provides for validation, which is our SOC 1, but then there is an independent validation that needs to be performed by the institution that, again, is either done internally by someone who is separate from the function, but knowledgeable enough to perform it, or secondly, using an auditing firm or some type of another validator. So Paul, I'll let you speak more to that, since it's really more in your wheelhouse than mine. But,
I was going to say, spoken like a true accountant there, Sean.
Yeah, you actually did a very, very nice job.
Thank you.
The regulatory guidance and the concepts behind model validation, like you said, they have they have two parts. First, you look at your kind of under the, vendor management, if you will. You ask the vendor, does your model work the way you portray it to work, the way it's expected to work? And so the vendor hires someone to put dummy data, and dummy assumptions, default assumptions and so forth. And basically the result of that is, hey, every time you put 2 + 2 in, my model always generates 4. The second part of model validation is to say, okay, if we take that model that is supposed to work and we put it in a particular institution, we have to see that their data is going in. So garbage, we're tracing data in. What are the controls over the input? Is the input correct? Is the mapping correct? Who's inputting that data? And then the assumptions that are put in, are those assumptions the ones that are approved by the governing body of the institution? In other words, if it's interest rate risk, that would be the ALCO committee. If it's regarding CECL, it's probably your board or a supervisory committee or a credit risk committee. So those assumptions are authorized, put in correctly, and are reasonable for your risk profile in your institution. And then finally, what about output? That report that's being generated, is it being reviewed on a timely basis? Is it being provided to the correct governance? So the model in the black box, the vendor says, no matter who we're talking about, whenever you put 2 + 2 in here, it's 4. Here's my SOC report. That the model, the black box works. The model validation that is at the institution level is this model being implemented in your institution correctly? Is the data going in correctly? Are the assumptions going in correctly? Are they authorized, and are they reasonable for your institution? And then what about the corporate governance? So that speaks to change controls. It speaks to access to the model. It speaks to a lot of things. So that's why that piece can only be done in the institution, because it's unique to the institution. But part of the whole model validation is the vendor model. And so that's the same way with our core. Every time we get a SOC for our core processor, there's always a section that says user controls. Somebody has to check to say, hey, are you writing your password on a yellow sticky on your computer, or is it secure? So that's the difference. When we're talking about model validation, we're talking holistically, the concept of model validation, not simply the vendor model validation. So I hope that's a little bit clear. I know it's an area that gets a lot of questions and is increasingly being focused on by regulatory agencies. By the way, we use a lot of models: interest rate risk model validation, the BSA anti-money laundering, if you do a credit or capital stress test using a model, liquidity using a model, all of those models, you have to periodically look at them and make sure that they're actually working as intended, because you're making decisions on that output. Does that help?
Absolutely. And then Steve, go ahead.
I was going to say, and for our part, what we can provide from a model validation standpoint is the first part of what Paul was saying. The generic part, right, was are all the operations that we're doing with the data correct? And that's what we do with our SOC 1. So in the process of updating our SOC 1, they pretty much they dig through our entire model, and I walk them through each step of, this is where the data is coming from, and it is accurate, and then these are all the steps, and they kind of follow through all those steps with us with a fine-tooth comb to make sure and give examples of how you get to those final calculations from the beginning calculations, from the source data, that it is all accurate and meets expectations mathematically and from an industry standard point of view. And then the way that we can assist you with the part of validation that we can't do is the data that's specific to your institution. So if you have hired someone to help with the validation for your part of the validation, and they need more data than the interactive tool has, we have an Excel tool that we can send you upon request that pretty much has every piece of data from the call reports and all the calculations that go with it through to sort of help you with that part of the validation that we can't necessarily, but we're not really allowed to do, so to speak.
Yeah,
Yeah.
because as you mentioned, there's some data like call report general industry data. Y'all know exactly where it is, and you can show where that comes from. But the model validation at the institution side is the institution's data sourcing and use correct? And then the whole issue of governance. In other words, who accesses it, who controls it, who reviews the results. So model validation is a little bit broader than just does the model go 2 + 2 = 4. So.
And so, Paul, the follow-up question was, do you have any suggestions for an institution that's looking to do the model validation for the first time?
It won't be fundamentally different than the second time or the third time. So, usually you have to have that quote unquote done as an independent. So, if you have somebody in your institution that is, first of all, not involved in the CECL process or modeling, and secondly, is knowledgeable enough to follow and do the work. And that's usually the problem. Usually the people that are knowledgeable about that are involved in the process. So that's often why you see people go outsource. If you were looking for trying to talk to firms about that, I would look to whoever provides your internal audit or compliance review. You can't have your external auditors do it generally because they're not independent then with respect to their audit opinion. They can't audit their own work. So typically you can't have them do it, but there's a number of firms that provide that type of a review, model validation review. And, it certainly you should check with them. I'd be happy to answer any questions anybody has about how the process works and so forth. But usually we don't do model validations right when you implement a new model, right? You usually wait about 6 months to let the dust settle and make sure that things are settled. And then periodically, whether it's annual or biannually, every 2 years, or anytime you change the model significantly, that's usually a pretty consistent expectation.
Perfect. And just a reminder, Paul won't say it, I'll say it for him. His firm certainly does model validation. They're familiar with CECLSolver. So if you are looking for an independent third-party validation, Saltmarsh can certainly assist you with that.
Along with a lot of other firms. But yes, thank you for that plug.
All right, let's jump back into the slides. I know we're getting close on time here, so let me reload my screen. Here we go. All right, Steve, we've got another tool enhancing the peer data in CECLSolver. If you want to touch on that.
Yeah, we can just stick with the screenshot here for now. But this is something we are still working on that will be coming out later, hopefully during the second quarter here, which is it's another tool to allow you to look at peer data trends in a different light. The way we do it now, we just show kind of average loss rates for your peer group over time, historically on an annual basis. And then we overlay your look back period over top of that those peer loss rates. So we can calculate a apples to apples lifetime loss rate for your peer group for each of the segments of the portfolio. But again, those are done at or just average kind of peer levels. Now, we've had a lot of users who kind of are looking to find a way to sort of stress those industry losses, stress the peer losses, so they can see what kind of trends are at the, let's say, 75th percentile or 90th percentile loss rate, meaning what loss rates for each year and for the entire loan lifetime for your peer group are worse than or higher than 90% of the credit unions in your peer group. And so this will just be another tool. When you go to the peer data, you can still see it the way we always have done it, and you'll also be able to toggle to this different methodology, which allows you to just kind of stress the peer losses at a higher or lower rate if you'd like to. You can do it on the whole shebang on every segment of the portfolio, or you can kind of go in with a scalpel and say, I want more stress on my auto loans, and I want less stress on my mortgage loans for the peer group because I think that's more appropriate. And you can do it that way as well. So keep in mind, this is just an alternative way at looking at your peer trends to help inform or justify your qualitative factor adjustments. So this is not going to change the model at all. It's not going to change your outputs or the calculations of your reserve at all. It will just give you additional information that you can use to change, alter, or justify your current qualitative factor adjustments. You don't have to use this at all. You don't ever have to look at it. If you like the way the peer data helps inform your Q factors, you don't have to worry about it at all. But we thought it could be a helpful additional way to consider peer trends.
Perfect. Again, Steve continually updates as the new quarterly information comes available just around some Fed data. Again, I think we see certainly in here, from institutions, on particularly regulators liking to see objective data, economic data as part of some of the discussions. So again, we just felt like we could share some, information straight from the Fed. Steve, anything you want to touch on here?
Yeah, no, this comes out once a year, right? The Fed comes out with this as part of their the stress testing scenarios, the DFAST type stress testing scenarios for the too big to fail institutions. And they update it in February of each year. And it's just they get their whole collection of economists and look at these particular indicators. We have quarterly data going back 20 years. And then on those exact same indicators, there are 3-year or 12-quarter projections going forward. The baseline scenario is an actual projection, is the average expectation of the economists on board, whereas a severely adverse scenario is not. It's a hypothetical scenario. It's not a projection. It's just a how bad could it get if it got bad, so to speak. So this data will again help you help directionally on justifying qualitative factor adjustments if we've seen if the baseline projection scenario shows continuing weakness or increasing weakness in a particular economic trend. You can identify that specifically and discuss it in your qualitative factor adjustments as part of your defense of them. So it's something we update once a year, every February.
Perfect. Thank you. And then finally, as Steve has and will continue to do, we have an increasingly growing database of not only institutions but scenarios. We like to share that data with you so you can get again some insights into what other institutions are doing. Steve, I'll let you take it from here.
Yeah, so we've already updated this for the first quarter, which is great. I know we've been getting a lot of requests to have this stuff available as soon as the quarter is over. And we understand exactly why. This is when you're thinking about and starting to consider your reserve calculations. And we know data is very tight or a lot of times simply not available during that filing period, which makes it difficult to see those current trends and defend those Q factor adjustments and everything else. And so all of our segment level WARM data and Q factor data and reserve data, collective pool reserve data from all of our internal users has already been updated for the first quarter, meaning all of the thousands of scenarios that our users have run between January 1st and March 31st have all been aggregated and organized and set up here. So if you go to that tab, you'll see it's updated for 3/31. All of the if you're pre-populating the tool with WARMs from the industry, that's already updated with the 3/31 data. So pretty much our whole system wide now is updated with all of the 3/31 data at a schedule, which is great. And we now have over 500 credit unions that I believe ran different scenarios during the first quarter, of 6,000 scenarios and 500 credit unions. So that database is getting more and more helpful directionally and robust as we move along.
Perfect. Along those same lines, Steve's got information on ACL trends. So
yeah, so this one of the other tools that we have on the platform that you guys can avail yourself of if you're interested in discussing discussing adding this to your subscription. We have an Excel add-in tool, which pretty much just is I wouldn't call it a free-for-all, but it gives you the ability to pull in any data point on any credit union, going back in time directly into an Excel environment. So you can let your imagination run wild on all the data that you can get using the Excel add-in. But this is data that I went ahead and pulled a couple months ago, just showing, I said, hey, I wanted to look at reserve trends over the last couple years for credit unions around the country. And I wanted to do it by NCUA peer group. I was curious as whether the larger or smaller credit unions typically have a higher reserve and which ones are going in which directions. And so as you can see here, as of the fourth quarter of the year, the biggest and smallest credit unions had the highest reserves. And then everyone in the middle had slightly lower, with $50 to $100 million credit unions having the lowest median reserve level of 68 basis points, and the smallest and largest guys significantly higher at 94, 95 basis points. So I thought that was a pretty decent disparity in different size groups. And then also regionally, we're curious just between the NCUA, the three regions that the NCUA is broken up into, East, West, and South. We show those trends there as well to get a little bit more granular with reserves by geography. And then finally, we wanted to get an idea, as you know, Paul alluded to, we've certainly been seeing cracks in the armor of asset quality. And while charge-offs have certainly not, gone off a deep end or spiked in any really significantly meaningful way, well before things become at the level of a charge-off, they become delinquent. And so the first way that we can get publicly available data on the direction of asset quality trends is by looking at the delinquent loans on the call report. So I pulled, as you can see here, it's just a little screenshot. I pulled all the credit unions in the country in peer group 5, and there are 1,100 of them. And I pulled up the last 9 quarters of delinquent loans as a percentage of total loans. So you can see there's also a lot of seasonality or cyclicality to these reserve levels, and how they are the fourth quarter of every year. Credit unions typically report significantly higher delinquent loans, and then in the first quarter of the next year, they always go down. So if you see those little trends on the bottom right there, they drop in the first quarter, then they go up for the rest of the year, then they drop and they go up. So really, you want to compare the same quarter in each year. So I boxed out in red, fourth quarter of 22, fourth quarter of 23, and fourth quarter of 24, or 12/31 of each of those 3 years, and looked at delinquent loans and total loans. And we have seen a significant escalation. Median delinquent loans were 44 basis points 2 years ago, and now they are 67. So a 50% increase in delinquent loans quarter over quarter over the last 2 years, and similar at the median level as well. So this is just the type of analysis that you can do using our add-in source, and we thought it would be helpful to just kind of share from an industry perspective what's going on.
Yeah, and there was a question about that, Steve. Where can they see that information? So this is stuff you've generated using our tool.
This is stuff I've generated. If you're interested in having access to this, reach out to us, and our sales team will give you a buzz and let you know how that works. It is a separate part of a subscription to get access to it, but then it gives you a whole world of data at your fingertips that we're happy to walk you through and give you examples of how to use it and demonstrate it for you.
Perfect. Any final questions? Go ahead and submit those now. Just a reminder, all of our past webinars and coffee talks can be found on our YouTube channel. The link's at the bottom. There's also, you can find that on the website. A couple of upcoming webinars. Next Friday, there's one on jump cost, small business growth. Another CECL coffee talk in May. Again, all of our webinars, if you register, you will receive a copy of the slides and a link to the recording. So certainly encourage you to continue to do that. And we certainly want to thank you for doing that in the past, and certainly today, and joining us as well. Any final words, Paul, Steve, for our attendees before we let them have their weekend?
No, just I have to repeat, I'm so very impressed with everybody, how hard they worked in terms of implementing CECL, and love the tools, Steve, especially the add-ons and so forth. But And I would just encourage you to be like flexible and nimble as we go forward, because 2025 is going to be probably a little bit challenging with respect to the increase in credit risk. So we'll see how it
Yeah.
all goes.
Yeah. Be prepared is a good mantra for the year.
Yeah, absolutely. Absolutely.
Steve, any final thoughts or comments before we let everybody go?
Nope. Hope everyone enjoys their weekend, and reach out to us if you have any questions.
Agreed. Thank you all very much for joining us. Special thanks to Paul for joining us today. It's great as always. Great to see you, Paul. Have a great weekend. We appreciate you joining us. You certainly add to into our discussions. And so, Steve, have a good weekend. We'll talk to everybody next month. Have a great weekend.
Thanks, everyone.
Thank you. Bye.